Today, we are going to look at the infrastructure bond investment and 5 things that you need to know about it. I will show you why it is one of the most preferred type of long-term investments. We will look at what exactly is an infrastructure bond. How does it pay interest? Can you withdraw money before the stipulated term ends? Will you pay taxes? And 2 ways through which you can make money from infrastructure bonds. Use the timestamps to guide you to the specific point you want to understand, but please try and watch the whole video to fully understand everything about these bonds in details. If you're yet to subscribe, let me take this special opportunity to request you to please join. There are more useful videos that are coming on money and business that you do not want to miss. And kindly show some love by clicking on the like button, and I will also appreciate some feedback in the comment section. So let's jump right into it. So what is an infrastructure bond? These are bonds issued by the government to finance public infrastructure projects such as roads, hospitals, or energy projects. It's basically a loan that you give to the government so that it can use it to do development. They come with a predetermined duration, say 17 years, 13 years, or 20 years. Each bond comes with its own unique timeline as per what the exact use of the money is and the timeline by which the government believes that it would have already repaid the loan. How is the interest determined or paid? First and foremost, the return on investment, known as the coupon rate, is market determined. It's not announced in advance, but after the bids have been done. The interest rates on these type of bonds are usually higher than other investment options, at times 12.5, 13, 14%, depending on the specific project required for. The interest is paid twice a year all through the duration of the bond, and the principal amount is collected at the end of the term. For example, if you invest 1 million and the coupon rate is 12%, you will receive 120,000 per year, paid in 2 equal payments of 60,000 in June and in December of that year, as stated in the bond prospectus. So if you wish to see how a bond prospectus looks like, I will leave a link on the description below where you can download the current infrastructure bond issue for March 2023 in Kenya. So what if you want to withdraw your money from the bond and say the term was something like 20 years, but at year 3 or year 5, you have an emergency or rather a need that you want to move your money into? So well, the bonds can be bought and sold in a secondary market after they have already been issued. This allows investors to exit by selling their holdings to someone else. And that's the only way that you can get your money back before the time lapses. So before I tell you about taxes, let me first show you how to make money from the infrastructure bonds. There are 2 ways to make money from them. One is from the interest rate that you earn every 6 months, and second is through something we call capital gains through selling at the secondary market. There are 2 things, a bond's price and yield, and these 2 are what will determine the value or what you can get in the secondary market. Let me help clarify this before I get you confused. A bond's yield is the actual annual return that an investor can expect if the bond is held all the way to maturity. And this yield is based on the purchase price of the bond and the coupon rates. A bond's price, on the other hand, usually moves in the opposite direction of its yield. When the interest rates fall, older bonds become more expensive and investors can charge a premium to sell them in the secondary markets, earning you more than you invested. On the other hand, when interest rates rise, older bonds become less valuable and trade at a discount. In that case, you won't need to sell because otherwise you will make a loss. And now about taxes. This is one of the reasons that it is one of the favorite options for investors seeking good returns. According to the law, there's an income tax charged on every interest earned from an investment, whether it is a fixed deposit, a SACCO, money market, or shares. But infrastructure bonds are tax exempt, which means you get to earn 100% of your interest. This is very attractive and makes them a one-of-a-kind investment option. So far, the infrastructure bonds are one of the safest investment vehicles and one that can guarantee to preserve your capital or principal. If you have learned something today, please let me know in the comment section below and don't hesitate to ask any questions. Please subscribe for other educative videos on personal finance, investment, and business. See you in the next video.